Now, oops. Hello, everyone. Evening. You can hear me right now and joining me. Drop a note, say hi. So I know you're with me on this session on Friday. I hope everyone had a crazy trading week. It was a week that is best summarized by Reddit. Reddit has wreaked havoc in the markets. All right, let's get started. I have Facebook user. Oh, now, so if you're joining us for the first time, as you see it scrolling at the bottom, please click on the StreamYard link in the post itself, all right, and approve StreamYard for access, Facebook access, so we'll be able to see you comment on our back end over here, all right? Okay, thank you very much for doing so. We'd rather have to know someone who's joining us rather than to have an anonymous user over here. All right, thank you very much. So let me talk a little bit more about what's going on this week. Okay, and then after that, we will move to the topic for the day. All right, so while we wait for the others to stream in and roll in over here, I'm gonna do a little short education. Yeah, I think I'll do just that. Okay, all right, give me a minute. All right, hi Terence, hi Jason, hi KT, hi Sui Heng. All right, hi Yikai. All right, Stanley and Aulun, thank you very much for joining me over here. All right, now, so let me get my charts. Where is my chart settings? I wanted to show all of you something. There we are. All right, so let me pull it out. All right, everyone, the craziness begins. All right, and of course, it's none other than GameStop. Okay, now, so GameStop has been absolutely crazy over here, right? But you also want to pay attention to something, and that is that this is definitely not, I would say it's definitely kind of precarious. All right, now, why do I say precarious? Because we have mixed signals right now. We have, let me bring out my drawing tool. First of all, you should never be trading it right now. Right now, but I say mixed signals because we have the price definitely surging higher. Okay, we have one indicator over here. It's not drawing too well. All right, which is the RSI that's going up. So, but we definitely have the stochastics that's coming down, which shows the divergence over here. All right, but the steepness of the MACD follows the trend. All right, so we have a very, very clear breakout. Now, so this is none other than what we call a 5, 6, 7, 8, 10 standard deviation move, perhaps. And things are, just absolutely crazy, absolutely crazy. Now, so let me show you why. Okay, let me show you why. I have no idea. Who's the? I can't see who's this. All right, but let me actually tell you something ironic. Okay, all right. Now you're talking about BB, and I hope you're talking about Perio. And ironic thing was this: I actually entered a trade over here, and I was long. All right, well, of course, without knowing what's going to happen to GameStop. Okay, there was just a bullish signal over here, so I entered it like at about $11 to $12. All right, and the next day when it gapped up over here, I was pretty surprised. Yeah, all right. So I sold half my position on the gap, all right, because I had a take profit order that was filled at $19. All right, I set it at 15, all right, but of course the market opened at 19, so I got it filled at 19. All right, hi Joshua. All right, now Joshua, can you click on the StreamYard link over here? All right, click on the StreamYard link, and then I'll be able to see you rather than a Facebook user. All right, thank you very much for letting me know. All right, now, so that was half my position filled over here, and the other half I actually got out at about 21. All right, so ironically, I was a little bit of a beneficiary, but I definitely did not trade because of GameStop. All right, I was already in DB before the whole move happened. But if all of you would like to know, right, why GameStop managed to push other retail counters like AMC, all right, and of course, COS. Okay, all these have very, very similar patterns as all of you realize, and also Nokia, right, which is one of the stocks that we have traded over here, right, and also BBBY. Right, you realize that all these stocks have what we call very, 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 very similar patterns. Yeah, all right. So they are all companies that are like left for the date. Okay, but they had a resurgence over here just because of what happened to GameStop. Now, so here's the deal, right? If you have watched my Facebook post earlier this week, right, you realize that I said that the professionals have came in the day after what has happened to the GameStop fiasco. All right, but when the professionals came in, they're not crazy enough to gain GameStop. All right, so what they actually did over here was they went after the retail ETF. Right, so they went after the retail ETF, and can you see this? Retail ETFs. ETFs are meant to be a basket. They're meant to be stable, right? But yet, look at this retail ETF. It shot from like 74 all the way to 99, right, in just 3 to 4 days over here. Right, so this was what the professionals were doing. Right, the moment GameStop came over here and pushed the up day, right, which caused the breakout, right, the next day over here, all right, the algorithms and the quantitative traders, they were pushing the XRT. All right, but in order to push the XRT, which is a retail ETF, all right, what will happen is they will have to push the stocks that are inside the ETF itself as well. Right, and that's why you see the mess going on over here, right, in all the retail stocks with the markets. All right, so that's how the professionals were playing it. And you must understand one thing, the algorithms, if all of you have heard before, right, they can enter orders and they can enter tens of thousands of orders, right, at the speed of light, which means they can always get in, right, and get out ahead of us. Which means if I see a big move right now, for example, happening in GameStop, I want to chase it, right? But before I can get my order into the system and sent to the exchange itself, right, these algos, all right, would have already fired 10,000, 20,000 orders, right, way ahead of me. Right, and at the same time, when they see that there's a downturn happening, right, they could send 10 and 20 thousands of orders, all right, to get out ahead of me again. Right, so this is why the retails are always left for the dead. All right, and another reason why, okay, that we had this amazing surge in GameStop, okay, it's not really so much of what we call this, people going out there and massively buying GameStop, all right, but it's more so of what we call people going out there, all right, and massively buying GameStop options, all right, and GameStop call options over here, all right, because if you had backtracked over here when it all started, okay, right, you realize one thing, all right, option statistics does not lie over here, all right, and the first day where GameStop actually surged ahead, right, okay, that means when it surged ahead over here, what happened was this, okay, the call options number that was traded over here, which you happen to look at call sizzle. Right, so if you're on TD Ameritrade, they actually have this sizzle index. Now, what the sizzle index does is it compares today's option volume over the average of the past 5 days. Right, and on the very first and second day over here, right, the call option sizzle on GameStop was actually 7. Right, which means GameStop call options were trading 7 times, right, the normal volume. Right, and think of it this way. I hope I can draw. No, I can't draw over here. This is not Zoom. Now, so what happens over here is, for example, if you think that GameStop is going to go up further, all right, and then you go out there and you buy a February call option right now. Okay, so you're going to buy a February, for example, say $340 call option. Now, so if you do that over here and when you send the order, okay, now what happens over here is this. When you send the order and your order gets filled, okay, the other party or the counterparty is actually what we call the market makers, right? But you must understand, if you are the buyer, that means your counterparty is actually the market maker, all right? But the market maker has no interest in taking any position at all. That means he doesn't have a view. His job over there is just to quote you, all right, a bid price and an ask price, and his job is just to facilitate trading and hopefully try to make money from the bid and ask orders that he's filling over here. Now, so what happens is when he gives you an order and he sells it to you, right, he's taking on what we call negative delta. Yeah, right, negative delta. Now, so what happens over here is what he must do, right, is immediately hedge. First, because, you know, a stock like GameStop right now, okay, is definitely trading at high betas. Yeah, right, they're trading at increased betas over here. Now, so what also happens is he needs to hedge his risk immediately. So what is he going to do then? right? Because when he sells you a call option, right, his obligation is actually to sell the shares, right? You must understand that selling call options gives you an obligation to sell the shares. So the only way he can hedge himself is actually to go into the stock market, right, and actually buy shares on his own accounts. Yeah, right. Because when he sells you a call option and he immediately buys a share, he's immediately hedged. Yeah, all right, because he has the stocks to deliver, right, in the event that anything happens. Right. So this is what market makers does over here to hedge their deltas. Yeah. Now, so imagine when there's a mass buying going on, all right, there's like 7 times the volume of call options. So these market makers will filling these orders all day long over here. But whenever they fill an order, they're going to the stock market and actually buying the shares. So it's not so much the retails, all right, buying shares in truckloads that has pushed the market, but the retail who has been buying these call options, all right, and then forcing the arm of the market makers to go to the stock market and buy GameStop shares that have caused this surge over here. Yeah, all right. And of course, what happens over here is if there are all these volume of short sellers where their stop loss to cover is over here, all right, and then when it peers through over here, all right, it triggers more buying back because all these short sellers have their stop loss triggered. So they add the buying on top of the market makers, all right, and then we have the next group, and then the next group, the next group, the next group. So it's like a never-ending chain. Yeah, okay. But what you must also understand is all these kind of frenzied activity, all right, comes very close, all right, at the point of a market top. All right, so while you go ahead out there and try to think that you can catch, catch this wave over here on the long side, right? You may be left ruining, trying to be greedy over here. All right, so it's never a good idea. All right, now, but if you want to be on the short side, all right, it's also not a very smart idea. Okay, now why is it not a very smart idea? All right, it's simply because if you go back to history, all right, and you actually just go to Google right now and you type in Volkswagen $1,000. Right, and you'll find that the short sellers were punished over here in Volkswagen, right, because when their shorts were being called out, right, they needed to cover, and there was just not enough shares out there. All right, so Volkswagen shares went from below 100 all the way to a peak of 1,000, right, before it substantially come back down. Yeah, okay, so if you want a short right now at 300, all right, you better think hard. Yeah, all right, and it's just not possible. Let me show you something. It's just not possible to even trade options. Now, okay, even if you want to trade GameStop options right now, it's totally not possible. Because if you look at the bid ask over here, right, it's 174.55 and the ask is 179.50. That's a $5 spread, which means, all right, no matter how you're going to negotiate, the market maker is in no mood to negotiate with you. All right, and if you bite the ask price over here, you're definitely overpaying. All right, and $5 for just one option contract, that's equivalent to $500. I'm sure you don't like overpaying $500 for anything that you're purchasing out there. Yeah, it's not $5, guys. It's $500. Yeah, okay. So that's why I'm really saying this way. It's just totally not possible, right? If you're telling me, but Terence, I could hedge this with doing a spreads and stuff like that. You can't, right? You can't. Let me show you why. Because if you're buying, for example, a call spread, it doesn't work out as well. Yeah, all right, okay, because you're buying at 186, all right, which has a $5 bid-ask spread. Okay, and then let's say you want to do it at $20. So you sell the 370. Oops, sorry. You buy the 350, all right, and then you sell the 70 here. All right, you're paying like 375 over here. Right, and that's not even including the slippage of the bid and ask between the two strikes. Imagine if you lose $5 on one strike and you have to lose $5 on the other strike. Yeah, can you imagine how much you have already lost before you enter the trade? Yeah, okay, now as you can see over here, guys, all right, they put restrictions out there. Yeah, all right, restrictions are still on TD Ameritrade. Okay, and let me tell you this, okay, this has nothing to do with any agendas at all. All right, what the brokerages are doing over here is protecting themselves. All right, they're protecting themselves because, all right, when the whole game busts up, all right, not right now, but when the whole game busts up over here, what's going to happen is there's going to be tons of margin calls on accounts. Yeah, all right, and the brokers are liable for all these margin calls over here. Right, and when it happens over here, the Securities Exchange will actually launch an investigation on the brokerages itself, right? If they protected the interests of their customers and their account holders. Yeah, all right. So instead of letting that happen, across the board, all the brokers are stopping this activity. All right, they're trying to stop it before it gets too crazy. All right, in a part to protect their business as well. All right, because they are lending you this money. All right, but they have no idea whether you're capable of paying those money off at all. Yeah, okay. So they're really protecting their own interests over here. Right, and it's well within their rights because when you open any accounts, there's always those disclaimers, right? Yeah, okay, the disclaimers are out there. Yeah, all right. How many of us actually read them line by line? I know Jerry does. Yeah, okay, because he's lawyer by profession. All right, but most of us just want to get our accounts open, so we agree to everything. All right, and you'll probably be one line over there that allows them to do that. Yeah, okay, all right. Now, so having said all that, okay, done with the lesson, everyone. Yeah, I don't want to be naggy. I don't want to be a grandpa over here because everyone is definitely caught in the euphoria of GameStop. So let me not stop your mood. If you want to be game on, go ahead, everyone. But just tread with caution. All right, tread with caution, everyone. I hope you find it useful. If you find it useful, just type it in the comments box to let me know. All right, that what I just shared with you was something you didn't know about. Yeah, when it comes to options trading and how options trading has taken over the stock market. Okay, now, so let's get to our portfolio very, very quickly over here. We have a down day right now. Yeah, all right. We have the selling resume in the marketplace. So what I'm going to do over here now is this. I'm going to close out. Okay, I'm going to look to close out. Thank you, Ikai. All right, thank you, thank you, thank you. All right, it's great to let me know that. All right, Josephine, thank you very much. Whoops. Thank you, Stanley. All right, now, so I'm going to close out my VIX position, all right, as my portfolio hedge because that's what it does and that's what it's supposed to do. All right, but let me check the premiums out. I have the 16th of Feb expiry, 20 strike put option. Let's see what it's worth today. Yep, I'm definitely closing it out. Right now, the reason why I'm closing it out, oops, the GameStop order is still there. Now, the reason why I'm closing it out, everyone, is because, right, if you look at it over here, yeah, all right, now, I could have closed it out over here just by paying 10 cents. Yeah, okay, the last done is 7. All right, but I'm just going to take 10. I'm just going to buy it at the ask over here. All right, so I'm going to close it, everyone. I'm going to close the VIX over here. Okay, it has about another 2 weeks to go, but it's only left for 10 cents. So I'm going to close it, and I will take $270 for 3 contracts over here on the VIX put options that we sold. All right, for this particular event, all right, a market correction. All right, now, so let's get going. So we got out today on the 29th of January. That elevates 6,000 off our accounts. Yep. All right, good to go. That's another profitable trade on the VIX over here. All right, now, if I do get another market bounce up, all right, I may reestablish another portfolio hedge over here. Now, our ED, all right, our ED stock has surged up over here because money has rotated. All right, you'll probably see that all these defensive stocks are probably up another round again today. That's because what happens over here is when market sense risk, yeah, okay, when market sense risk over here, what it does is it shifts money. All right, it shifts money from what we call where are we? Yeah. Let me pull this back. Right now, it shifts money from the technologies or the high risk sectors, all right, into the defensive sectors. All right, and then yesterday we had a big bounce, all right, and so what happened? Money flew out of all these defensive sectors, and it definitely went back into the technology stocks. Right, but today we have the reversal, so we see that all these defensive stocks are back up by at least a 1% or even more. Right, look at our CPB, look at our Kellogg's. Kellogg's is flat, right? But on a down day, it's not too bad. Yeah, right. And then we have things like Hormel, yeah, right, which is also up. Yeah, right. So you saw all these, food-related companies, which are very staple industries. All right, they had all these benefits over here during the market sell-off. Right, and in our community, we're selling a lot of these options over here, and we're closing them out for profits even when the markets were collapsing. All right, so that's a good one over here. CPB is doing well over here. Let's check out the premiums and see if I can close anything at all as well. Now it's a little bit wide right now, so I can't do much. So we have the 19th of Feb, right? 19th of Feb, $46 put options. All right, so the bid ask is really wide, so I'm not taking any action right now. It's 50.80. Yeah, okay, because market is selling off. So that's usually what happens. And I would expect market to stabilize only about after an hour, right? Perhaps an hour after it has already opened. So this usually happens on very big swings on market opens, and more so on the downside rather than the upside. Yeah. Okay, so this is the main reason why we have all this very, very wide bid ask that's happening right now. So I won't be closing any of the trades, but let's see if I can open the trade that I put up in my mind today. So let's see. Yep, it's still available, so I'm going for it. Now, so what's going to happen over here is I'm just going to put myself into another defensive kind of stock over here. All right, I'm going to put money into AT&T today. All right, so I'm going to put money into another telco. I have one on Verizon. I'm just going to put more money into AT&T. Now, so I'm going to sell the April, all right, 16th of April expiry, which is 77 days. So this makes it easy calculation. It's just 10 weeks out. All right, it's a 10 weeks out option expiry. And I'm going to sell the 28 puts, all right, and try to collect about 116. Let me try to place it for about 116 right now. Yeah, okay. So I'm going to sell 3 contracts of this AT&T portfolio puts. So before you go ahead, let me just do a reminder over here. What happens over here is this. Oh, it's immediate fill. I cut short myself. I shortchanged myself. I could probably ask for more. Hang on over here. Don't go out there and just do it, everyone. Yeah, all right. Listen to my disclaimers first. All right. So we are discussing live trades, and I am placing these live trades on live portfolios that we have over here. Right. But before you do so, please do your own risk assessments and judgment that you're comfortable with the shares and comfortable with the trades that I'm doing, and you actually understand the risk behind it before following suit. Now, so in our segment, which is a public segment that you're hearing me talk about right now, right, the only strategy we deploy is what we call portfolio puts. Okay, now portfolio puts are basically selling put options on stocks we are more than happy to be owners of. So in the event that anything happens and we have to fulfill our obligation, right, we would have the capital ready to buy up those shares. Right, so I'm going to do a typical contract size over here of 3 contracts. Okay, so I'm seeing 3 contracts over here. And as all of you can see, all right, it's already filled 3 contracts at 116, all right, at about 52 minutes. Okay, that's about 1 minute ago from now. Yeah, okay, so it's filled for 3 contracts at 116. So let's go ahead and populate this and see how much capital, all right, we need to put up over here for this trade. All right, so let me fill it up. My orders for last week was actually not filled. Yeah, okay, so that's why you don't see an entry over here. Right, so this trade on AT&T is filled today, so you'll make it trade number 33. Oops, T. Right, I'm doing it for 16 April. Right, so it's the $28 put option. All right, we are doing this on the 29th of Jan. All right, so I'm pocketing 1.16. Right, that gives me $348 in premiums and my deposit requirement. Right, it's gonna put me up to 90,000 over. So after this position, I'm probably a little bit maxed out over here on my portfolio. Right, I do have Nokia shares right now, and unfortunately, right, how unfortunate, everyone. Yeah, all right, we sold the call options. Okay, we sold the 450 call options over here just last week. All right, it was 22nd. Oh my goodness. Yeah, okay, but nobody would have guessed GameStop. Yeah, all right, nobody would have guessed GameStop. All right, our 5G play on Nokia didn't pan out. Right, so that made me make the decision of selling the call options to collect premiums. And who would have known? Yeah, all right, GameStop have gained Nokia too. Yeah, right. But if you didn't sell the calls, all right, you should consider taking your profits if you got delivered the shares. I would do so. Yeah, all right, I would do so over here. Right, but we're stuck right now. So my options expire on the 19th. Yeah, all right. All right, Josephine, well done. All right, so on the other half right now, you might want to consider taking half of the half over there. All right, so you realize some profits and then play with the remainder of the positions for an upside. That's something you want to think about, or you can just take off everything if you think it's good enough right now. Yeah. All right. Congratulations, Josephine. Right now, so yep. So AT&T we have added on. So my portfolio is pretty max right now. So we'll probably have to close some positions before we reopen any ones for this portfolio. Yeah. Right now, so let's calculate the ROI on this trade. So we are pocketing 116 divided by capital requirement of $28. Sorry. That will make this an ROI of 4.14% over a period of 10 weeks. Right, so if I annualize this, dividing it out by 10 weeks and then remultiplying it by 52 weeks, right, would still bring this trade that we did today at a 21% ROI per annum. All right, and please look, everyone. Sarah, well done. All right, you kept 30%. All right, okay, awesome, awesome. All right, now, so there's some huge profits made by some of you who are joining on these sessions. That's pretty awesome. All right, now, for those of you who joined me and Jeremy, all right, on the weekend session, all right, we talk about this fancy trade over here where we sold a call option and then bought another call option on it, right? That was just too bad. Imagine if we still had that trade over here and it has not expired, all right, because that trade expired on 15th of Jan, all right, and we are now about 2 weeks after that and the surge happened, all right? That would have been a jackpot winner of like 3, 4, 5, 600% ROIs over here with this surge, all right, if that combination trade was still on. Yeah, right. If you remember, you'll be knowing what I'm talking about. You're just a little bit too early, right? But you know, that's trading. All right. If you want to trade, you have to be ready, prepared for those kind of outcomes. Now, so this AT&T trade is a 21% ROI per annum, and I'm putting up full cash. It's almost as good as buying the stock. So this is a very good alternative if you do believe, all right, that buying an AT&T stock, all right, and holding it for the next 1 year, all right, you cannot see yourself generating a 20% ROI, all right, this is where a portfolio of selling options, all right, will allow you to achieve much, much better returns. All right, okay. Now, so I'm about to end the session, but I'm more than happy to take 1 or 2 questions. All right, so if any of our attendees right now have, you know, questions that you want to throw out at me, all right, before I end the session for this week, all right, please do so and type them in the comment section. Yeah, all right, feel free to type in the comment section. Right now, so meanwhile here while waiting to see if anybody has any questions, if you are new to option selling and new to this StreamYard session over here together with me, welcome once again. And if you do find it interesting and you want to start your own journey as being an option seller, right, and do the same kind of trades, for example, like AT&T trade over here, all right, a 3 contract trade today, all right, would have stumped up a capital requirement of 21,000. Right, but being an option seller in our community, right, you could possibly do the same 3 contracts trade over here, right, with just a capital of under $1,000. Yeah, right, and that's the beauty of learning strategies and knowing exactly what you need to do, right, to minimize those capital requirements and yet not actually increasing any risk at all. Yeah, right, not increasing any risk at all. Right, so if you'd like to be able to find out how to execute these strategies, email my team over here at the email address that I'm scrolling at the bottom. I've not done so. I have, yeah. All right, email the team over here, all right, at this address, all right, and ask for our trading membership right now, right, where you can actually be joining us for up to 104. Listen carefully, everyone. 104 live trading webinars every year. Right? And yes, we are running 104 live trading webinars every year, right, for our members over here. Right? So if you want to embark on your journey and you like the idea of being able to trade with us for 104 live trading webinars in a year, right, please send an email to my team. Yeah, right, send an email to my team. Right, they'll be getting in touch with you. Right, with more details, of course. All right, now, so Peter, all right, I'll do so next week. All right, Peter. All right, in our members section over here, I'll do the AT&T over here next week with all of you. All right, okay, Peter. Thank you very much. So Facebook user, I apologize for not being able to call you out by name. Okay, not being able to call you out by name, but Facebook user. So why do I think AT&T is a good time? One. Right, in a market that's volatile like right now. Okay, if you are on the bullish side, that means you think that you want to make money when stocks go up or do not tank, do not crash. Right, you need to start eyeing for defensive sectors. All right, and not only defensive sectors. All right, you want to also eye for companies that are more or less very stable and also undervalued. Yeah, all right, stable and undervalued companies over here. Right, and of course, just as a bonus over here, another thing that you can look out for over here is really the beta. All right, so if you're trading on TD Ameritrade platform, if you click on this down arrow, right, you actually see that the beta appears here right at the corner, right, and AT actually has a beta of 0.76, right. Now, what does it mean? Right, it simply means that if the index moves up or down by 1%, right, AT&T only follows it by about 0.76, All right, so the index ETF, the index, for example, SPX, right, has a beta of 1. Right, so the SPX, which is the S&P 500, has a beta of 1. Yeah, okay, so when you see a 0.76 for AT&T, it simply means that, all right, it tracks it at only 0.76. Right, so it moves less volatile than the index movement itself. Right, so that's what it really means over here. Okay, right, and of course, you know, me and my community members, we have been trading AT&T and selling options on AT&T for, like, you know, since we started 8 years ago. Right, we've made tons of, you know, options off AT&T as a stock. And $28 strike is really one of those safety barriers over here, right? So it's like one of those no-brainers when we get a good opportunity, right, with those kind of strikes and the conditions align, right, which I'll be covering in our mentorships and our trading memberships, right? And, you know, it's like a no-brainer trade that we do. Yeah, right. So all I'm doing over here is executing it. All right, now. So thank you very much, Sarah. All right, thank you very much for telling me. All right, I'm really honored over here. All right, now. After many years, Sarah, you have been with us for, like, I think 6 years. Yeah, right. You've been with us for like 5 or 6 years over here. Yeah. Okay. All right. Now, and, you know, 36% return for 2020. It's, you know, it's pretty good. Yeah. All right. Awesome. All right. Thank you for letting me hear that. I'm, you know, really glad and happy over here. All right. Oops. Okay, Josephine. All right, your covered call theory is very important. All right, get to know that you can sell covered calls on shares on hand. Yes, you can. All right, yes, you can. All right, definitely you can as well. Terence. So Terence's question is, VZ has a big down day over here in the last 2 days. Right? Can you actually use this as an opportunity to sell more puts? Think of it this way, Terence. Think of it this way. Instead of adding more positions on VZ, all right, by opening a new position on AT&T, I'm actually taking on the similar kind of risk, because VZ is a telco company, AT&T is also a telco company. All right, so rather than adding or doubling down on VZ, all right, what I did as an alternative was to open up a new position on AT&T. All right, and both companies pack the same risk over here, or very similar risk. Yeah. All right, Terence, I hope that explanation over here helps you understand the concepts and the idea a little bit better. Right. Okay, thank you very much for the questions over here. Now, so this is it. I will be going offline over here, and thank you very much for once again joining me in this session over here today, everyone. All right, and if you have benefited from the session, do me a favor, click on the share button. Just leave a short comment out there when you share the video to let people know, all right, how to be able to benefit from this Facebook Live video when you watch it, all right, and also to join us for every Friday session, all right, where I'm actually running this live, all right, for the benefit of all of you. Okay, all right, now click the share button, click the like button as well if you like the topic that I've covered today. Yeah, okay, thank you very much, and I look forward to seeing all of you again live on Facebook next week, everyone. Yeah, all right, live on Facebook next week. Hulk, send an email to our team as well. All right, Hulk. All right, you want a refresher? You're more than welcome. All right, send an email to our team. Welcome, Peter. All right, welcome, Peter. All right, thank you very much, Sue. Yeah, okay. All right, thank you very much, Peter. Now, have a lovely night and a great weekend, everyone. All right, and if you, once again, before I go, all right, if you're looking to join and make yourself an option seller and learn the exact skill sets of how to do so, and also trade alongside with us 104 times in a year, right, in a live trading webinar format where we take live trades all the time. Yeah, all right, email my team over here. Now, thank you very much, and I'll see all of you at the same time, same website, same social media, Facebook group over here, everyone. Thank you very much. This is Terence Tan signing off, and I'll see all of you next week. Bye-bye, everyone. Thank you.